In this week's video, we'll examine the question, are we seeing a garden variety bear market rally or a new bull surge in stocks? We'll also cover concerns related to overhead supply relative to the hard data we have in hand. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In last week's video, we covered these bullet points that told us to be open to a bottoming process and a rally. The following week, or this week, the S&P 500 gained 63 points. So it's fair to say that the market confirmed these bullet points here, and we will consider them to be confirmed until the data we have in hand says otherwise. That could happen, but we didn't see it in the following 5 trading days after these bullet points. This is somewhat of a generic chart from history. This is the S&P 500. It's a daily chart. It is not 2015. We're using a historical example to help us keep an open mind about 2015. If you don't know what overhead supply is, it's relatively easy to understand. The concept here, market made a high and then dropped. The concept of overhead supply says that when we're down here, everybody that bought in here is at a loss. Therefore, if the market rallies and these people start to get back to break even, they might say, I'm going to get out and get my money back. So there's somewhat of pent-up potential selling pressure in all of this overhead supply. So in this example, when the market falls, we have really 1, 2, 3, 4, 5.5 months of overhead supply. The rationale might be, I can't buy this low because this overhead supply is going to act as resistance, will be rejected, and will go on to make a lower low. What actually happened in this case? In this historical case where we had 5 months of overhead supply, it did not act as a permanent barrier. If you bought this low here, stocks went on a really impressive run. This is not a commentary on 2015, and we understand that 1996 is different than 2015. That's true for all historical references about the market. The purpose of the exercise is to say overhead supply, like resistance and like support, is a possible barrier. It's possible overhead resistance. Is it something to be concerned about in 2015? Yes, it may turn out to be a barrier, but we don't know that. And under the CCM approach, we don't anticipate or forecast. We make decisions based on what is actually happening. Let's go back to the original chart that looks a little bit more intimidating. And let's assume that I didn't buy this low primarily based on a potential barrier in the form of overhead supply. What did the long-term outcome look like after this period here? The answer is the long-term outcome was very favorable. With the benefit of hindsight, if you looked in the rearview mirror from the spring of 2000 back to the period of overhead supply and a potential barrier, it's even difficult to see on the chart. I cannot emphasize enough, we are not forecasting what is going to happen in 2015. We're looking at this because it helps us keep an open mind about all outcomes in 2015. This is potential resistance, we respect that, but it's potential resistance and overhead supply, and we respect that as well. We have indisputable improvement in the hard data. The bullet points that we showed a week ago today the 60-point some odd gain in the S&P 500 the following 5 trading sessions or this week, and we'll go over numerous examples of indisputable improvement in the hard data. It is also indisputable that the long-term trends still have work to do, and it's indisputable that we may have overhead supply in 2015 that will become a problem. Our allocations balance the two, taking the attitude that price will decide which piece of evidence wins out. Also, another reason to keep an open mind. This is a quarterly DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies LLC. Purpose of the exercise here. This line is one of DeMark's proprietary tools. It tells us, based on the way the market has behaved in the past and where it is here. So this is a trend line here. It seems like the market in 2015 held at a logical level. It held here, it held here, it held here. This yellow area here in DeMark tells us that if we go below that, the momentum favors dropping down towards 1680, but we haven't gone below it and we've held here. This tells us, taking a long-term view, this is a quarterly chart, that we could rally all the way to 2344. That's not a forecast. It's just an offset to the negatives that are associated with legitimate concerns about trends and overhead supply. Here's another example from history. We examined this one in 1996 and then the gains that followed. Look at the overhead supply here that starts in 1993. When you're down here, you have a tremendous amount of overhead supply. Same thing when you're down here. In this case, the overhead supply does prove to be a barrier, so it can be a legitimate concern. You can see this line here, price on this rally is rejected at a logical level if you look at this chart up close. Eventually, when you're down here and have somewhat of an overwhelming run of overhead supply, potential overhead supply, the market breaks out to the upside, telling us to keep an open mind about all outcomes in 2015. This is a weekly chart of the S&P 500 during the session on Friday, October 9th, about 3:18 p.m. Eastern Time. What once acted as support may now act as resistance. We broke above this downward sloping trend line and closed above it this week. All things being equal, it's another form of observable improvement. This is the fear index weekly that we've been looking at on Twitter and in last week's video. What once was resistance may now act as support. We broke down and lost the fear breakout on the weekly VIX. All things being equal, being below 2228 is a good sign for the stock market bulls. The VIX dropped over 17% this week. S&P 500 daily, as of Friday, October 9th, the market held at a logical level 3 times. This is similar to this angle here that the market cared about. If this trend channel were still in play, and that's not a prediction, if we rallied back to the top of the trend channel, bottom, top, top, bottom, bottom, if we went to the top, we would move over 2130 on the S&P 500. Not a prediction, it's just one of many possibilities. Barriers, we do have them. Barriers here, this is your overhead supply, barrier here. As we've said many times, bottoms can be a volatile process. Even if we've made a bottom, it's possible that we get rejected in these areas here and move around and consolidate. We'll keep an open mind heading into next week. This is the positive divergence that we showed on Twitter, and it did help us in terms of the breakout that occurred after seeing the positive divergence on daily RSI. It's a daily chart of the Dow as of the close on Friday, October 9th. Support, 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 resistance, 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 resistance. We cleared all of those levels this week. We also have the overhead supply concern here and some horizontal resistance that may come into play, but this is a good sign and a good step in the right direction. We've got a lot to cover this week, so one point on this chart that we've shown for a long, long time. The NYSE Composite Weekly was able to recapture this level that we've been watching. This is 10,301. We closed at 10,361 on Friday, October 9th. All things being equal, the longer we can stay above this line, the better for the bullish case from a probability perspective. S&P 500 daily, October 9th. Good sign here, break above, good sign here. Potential resistance in the form of a trend line that may come in somewhere in the neighborhood of 2050 or 2040. The charts we use are from stockcharts.com. These are some great tools there. These are the pivots that we've been watching on Twitter. 2 points. We closed above both daily pivots this week, and we also cleared some resistance here. Next potential resistance using these tools, 2030, and then after that above 2080 on the daily S&P 500. Before we review this chart, let's talk a little bit about the overhead supply that's up here. Every single correction in the history of the stock market, by definition, has to overcome overhead supply barriers. How can that be? Well, by definition, a correction occurs within the context of a bull market and within the context of an ongoing uptrend. So the correction goes on to make higher highs and thus has to, by definition, clear overhead resistance. Now, admittedly, this is more difficult overhead supply and resistance, but we saw something similar in 2011. There was overhead supply and potential overhead selling pressure. And of course, the S&P 500, it was a potential barrier that was eventually exceeded because the market went on to make new highs. No predictions about what happens in the present day, just some points to keep an open mind when we get back up here, if we do. We may not even get to these points. All forms of resistance are potential resistance. The fibs that we've been watching, on a daily basis, we closed above the 50% retracement from the high to the low for the first time. That's a good step. We have other hurdles above, including the 61.8 near 2032. S&P 500 daily, this is just a clean visual showing us that this rally is different from the previous two rally attempts. Regular viewers and clients know we're not big fans of projections and forecasting because it brings bias, but it can be helpful to understand the range of possibilities. This could be what's known as a double bottom or a W formation. The projection from the breakout that we received this week would be somewhere in the neighborhood of 2108 on the S&P 500 to 2123. Not a prediction, just a possibility, one of many scenarios. We discussed this in length. You can see these charts are dated October 2nd. You may remember in last week's video we showed these ratios and said concerns remain and that we wanted to see better performance near a low from JNK junk bonds, small caps, and the stock market relative to the bond market. All three occurred this week. Improvement, improvement, improvement on these ratios. Another piece of evidence that aligned with the bullet points from last Friday, something that happened after the bullet points. You can pause this and read it, or better yet, Google stock charts and breadth thrust, or NYMO, and you can find it. But we had what is known as a breadth thrust this week. We moved from this level to this level. You can read it. The point of the exercise from stock charts, most important lows are marked by a sharp surge in market breadth, which is what we had last week. It doesn't tell us anything about what will happen in the next few weeks. It just speaks to probabilities and matches up well with the reversal bullet points that we covered last week. We said we were going to cover observable improvement that's occurred in the hard evidence. That's what we're going to do now. Regular viewers, bear with me. I'll explain this one time, and then we'll use it on multiple charts, and we'll scroll through them very, very quickly because the concepts are going to be identical on every chart. This is the S&P 500 weekly. These are moving averages that the CCM market model uses to help us discern between lower probability periods and higher probability periods. A full-bore bearish look, 2008, is when price is below both moving averages. Blue is below red and the slopes of both are down. A full-bore bullish look, or a more favorable look, is when price is above both moving averages. Blue is above red and the slopes of both are up. This is the same chart as of Monday, September 28th, before the reversal process started. As you can see, this looks almost identical to this, telling us that on Monday, September 28th, we really didn't have any boxes to check here. What type of improvement have we seen since then? The answer is significant improvement. This is during the trading session on Friday, October 9th. This chart actually closed a little bit better than this because the gain for the week was higher than 58 points. If you're a client, this is the look that we had very, very recently. This is an unfavorable look, and that's why we were allocated the way we were. This is unquestionable and indisputable improvement in the probabilities. It doesn't tell us anything about what will happen next week other than the risk reward for an investor is much lower here than it is here. We've moved from a full bore bearish look last week, this is what we looked like, to a full bore bullish look with price above both moving averages, blue above red, and the slopes of both are up. Similar concepts, many of these charts we're showing are used by the model. Some are not used. We're using all of them to illustrate basic concepts. Tuesday, September 29th, if we want to put our capital in harm's way when the odds are favorable, this looks a lot like this and is not particularly favorable. How does the same chart look today? We have significant improvement on the same chart as of Friday, October 9th. We've moved to a full-bore bullish look, telling us that the probability of good things happening is higher today than it was just a few short days ago. Is it possible that we get whipsawed on all of these charts? Yes, it's possible, and that's why the CCM market model diversifies using numerous time frames, numerous charts, and numerous risk-on, risk-off ratios, as well as numerous indicators. Elsewhere in this video, we mentioned that we had seen improvement in this ratio, stocks relative to bonds. This is the ratio in 2015 with a full-bore bearish look on Tuesday, September 29th, against stocks and in favor of defensive-oriented bonds. This, in 2015, looks a lot more like this than this. Fast forward to Friday, October 9th, and now the same chart looks a lot more like this than this. Also, this is hard observable data. It's facts. The overhead supply and resistance that we have falls under the it may be important or it may happen. It may not happen. This has nothing to do with a forecast. I can see it and I can measure it. It only speaks to probabilities. It doesn't really predict anything, and it doesn't say that overhead supply won't be a factor. But that has a lot of ifs and mays attached to it, where this, right now, is factual. Tech stocks are the XLK ETF as of Tuesday, September 29th. This is an unfavorable look. And if we fast forward just a few days ahead, we have a much more favorable look from a risk-reward perspective. Probabilities and risk-reward tells us that we still have uncertainty. The uncertainty with this look is a little bit more in our favor, quite a bit more in our favor than having a look like this. You can see here, this is the S&P 500 on the bottom. When stocks bottomed in July and June 2010, the ratio of the S&P 500 relative to the VIX also improved. This is the same ratio on September 29, 2015, and the same improving look, similar to this look, that occurred at the low in 2011. This is the S&P 500 here. This is an unfavorable look on Tuesday, September 29th. Today, mid-morning on October 9th, we don't have a full-bore bullish look, but we still have improvement. Price is above both moving averages. The slopes of both of them are up. We're only missing one thing, which is blue above red. The model takes that into account. This is incremental improvement. We can see it. Is our model, or any model or trading system or moving average system or trend following system, the holy grail of investing? The answer is an emphatic no. There's no such thing as a holy grail in investing. All of this just helps us with probabilities, energy. This is what a bottom looks like, the stock market bottoming here in 2010. This is what a bottom looks like from a probability perspective. This is an unfavorable look. We don't want to deploy our capital into a look like this. This is Tuesday, September 29th. Fast forward, and we can see significant improvement during the day on Friday, October 9th. This is not a chart used by the model, nor does XLE use these moving average pairs. This is just shown for illustrative purposes only. Also, as we showed on Twitter this week, moves in energy off this low occurred on extremely strong trading volume, which is also a sign of increased conviction and increases the probability of the bullet points from last week turning out to be helpful longer term. Similar concepts when stocks bottomed in 2010. This is the S&P 500 bottoming here. We could see observable improvement on the weekly chart of XLI. In a similar manner, 2011, the stock market down here is bottoming, and this chart goes from a full-bore bearish look to a full-bore bullish look. Not a favorable look on Monday, September 28th. Has this chart improved? The answer is yes, full-bore bullish look. Why do we look at so many charts? It speaks to the weight of the evidence. How many pieces of evidence can we present of a potential bottom? And we can weigh that relative to things that might happen up here, things that very well may happen. We have to weigh that, the good and the bad, including trends that still have work to do. And the model does that with its allocation between growth-oriented assets, cash, and conservative assets. Two more points before we leave. It's been a very, very, very frustrating market. At some point, when you get a probabilistic look like this, and if you continue to implement properly, you will be rewarded with a multiple month trend. We have been executing properly through what has been an incredibly frustrating and difficult market for everyone. This is a very difficult period, but that's not that unusual in the stock market. This one is a little more unusual. How do you handle all of them? You continue to execute consistently. Eventually, looks like this will morph into profits from a probability perspective. We have numerous favorable setups. Will they work this time? We don't know that, but we know if we consistently implement, eventually we'll get something that looks more like this. How do we keep track of all this and make decisions? That's what the model helps us do. Market breadth, September 28th. This is what a bottom looks like. This is what a bottoming process looks like. This is what the chart looked like on Monday, September 28th. Fast forward, and we have another form of observable evidence, observable improvement that is adding to that list of good things that we're seeing as of Friday, October 9th. 2 points here. The weekly chart, for a new trend to start on any time frame, at some point we have to move from a series of lower highs and lower lows and flip over to higher lows and higher highs. We have those pairs together now, which also speaks to probabilities. Short covering. Has short covering been a big part of what's happened? My guess is yes, it has been a big part. Has it been the only reason? Probably not. Why? Because a short covering rally typically is a very short burst where the shorts cover. They have to buy. Once they cover during that period, there's no fundamental reason for that demand to remain in place. So a short covering rally typically is a big move up and then it's quickly given back. That's not really what we have here. Once we made the low a week ago, for the most part, we've gone up, consolidated, gone up, consolidated, gone up, consolidated. That doesn't really look like a rally that's based primarily on short covering. There are other factors potentially at work here. Weight of the evidence, 100-week moving average was rejected in 2008. This week we recaptured the 100-day moving average. Is it possible we get a look like this? Sure, it's possible. The longer we stay above it, the more meaningful it becomes. Last week we showed some good and concerning things on this chart. 1 point and 1 point only. We wanted to see CCI and other weekly indicators move out of oversold territory. We didn't have that last week, and in most cases we do have it now, which is another form of incremental improvement tracked by the CCM market model. The market model uses indicators on many of these charts as well. It answers binary questions, and it also looks at hard data. A fair question might be, Chris, if you've seen all this improvement, why have we not thrown 100% of our assets into the stock market and leveraged ourselves to the hilt? Because some things have improved. Many things still need to improve, and we still have numerous concerns in the form of overhead supply, resistance that has to be cleared, and longer-term trends that are still damaged and concerning. Weekly chart as of Tuesday, September 29th. This is a full-bore bearish look. Blue is on the bottom, price is below everything, and the slopes are all down. These are longer-term moving averages, weekly moving average, relative to the ones that we've covered with the blue and the red in this video. How do these longer-term hurdles look today? The answer is, as of Friday, October 9th, it looks a lot better. However, there's still work to do. A full-bore bullish look, like July 2009 here, is when blue, the fastest moving average, is on top. Today, it's still on the bottom. So we do have improvement with price moving back into this area and moving above numerous moving averages. We can observe that and measure it. We also have slopes turning up here that we can observe and measure. But there's work to be done, which means risks remain. This is not a full high probability look. It's an improved look. And that's why our allocation to stocks has increased. But it's also why we're not 100% in equities. We still need to see more And these trends are telling us to respect that even if we've made a bottom, we could still see consolidation, frustration, and volatility. All of this tells us to move into next week with a flexible, unbiased, and open mind. The charts, the hard data, and the market model will guide us if we are willing to execute consistently through the frustrating periods and the periods where we're rewarded. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.